Hello student, welcome to the lecture on concept of value and return, and after this lecture we will be able to learn the following objectives. Explain the importance of time value of money, describe the future value of annuity, explain the net present value, define project selection and evaluation, discuss the capital budgeting. Time value of money, which serves as the foundation for many concepts in finance, arises from the concept of interest. The value of money is not constant. Thus, the concept of time value of money arises. Time value of money. The time value of money impacts business finance, consumer finance and government finance. Time value of money results from the concept of interest. Money has time value. A rupee today is more valuable than a year hence. It is on this concept the time value of money is based. The recognition of the time value of money and risk is extremely vital in financial decision making. Time value of money is central to the concept of finance. It recognizes that the value of money is different at different points of time. A certain amount of money today is more valuable than its value tomorrow. The difference in the value of money today and tomorrow is referred as time value of money. Reasons for time value of money. Money has time value because of the following reason: risk and uncertainty. Future is always uncertain and risky. Outflow of cash is in our control as payments to parties are made by us. There is no certainty for future cash inflows. Inflation. In an inflationary economy, the money received today has more purchasing power than the money to be received in future. Consumption. Individuals generally prefer current consumption to future consumption. Investment opportunities. An investor can profitably employ a rupee received today to give him a higher value to be received tomorrow or after a certain period of time. Cash flow statement. The cash flow statement reports the cash generated and used during the time interval specified in its heading. The period of time that the statement covers is chosen by the company. The cash flow statement organizes and reports the cash generated and using in the following categories. Operating activities converts the items reported on the income statements from the accrual basis of accounting to cash. Investing activities reports the purchase and sale of long-term investment and property, plant and equipment. Financing activities reports the issuance and repurchase of the company's own bonds and stock and the payment of dividends. Supplemental information reports the exchange of significant items that did not involve cash and reports the amount of income taxes paid and interest paid. Following are the ways in which statements of cash flows is used. The cash from operating activities is compared to the company's net income. The cash flow statement identifies the cash that is flowing in and out of the company. Some financial models are based upon cash flow. For further details, have a look on this video.
Of the amount of cash and cash equivalents that flow in and out of a company for a specific time. Cash includes currency, checks on hand, and deposits in the bank. Cash equivalents are short-term, temporary investments, such as treasury bills, certificates of deposit, CDs, or commercial paper that can be quickly and easily converted to cash. Why is the cash flow statement important? Because cash is the lifeblood of your business, and the cash flow statement helps you understand where money is coming from and where it is being spent. It also alerts you to when a cash flow problem may be coming. The cash flow statement is one of the four main financial statements, which are balance sheet, income statement, cash flow statement, statement of shareholders' equity. A cash flow statement tells you whether the company generated cash. It shows changes over time, usually on a month-by-month basis, rather than showing an absolute dollar amount at a point in time. It uses and reorders the information from a company's balance sheet and income statement. What makes up a cash flow statement? Generally, the cash flow statement is broken down into three sections. cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. Let's look at each in terms of cash receipts, considered cash in, and cash payments, cash out. Cash flows from operating activities reflect how much cash is generated from a company's products or services. Cash receipts include the sale of goods or services, as well as income from items such as interest and dividends. While interest or dividends could be considered financing activities, the Financial Accounting Standard Board classifies them as operating activities. Operating activities also include your cash payments, such as inventory, payroll, taxes, interest, utilities, and rent. Investing activities reports the purchase and sale of long-term assets, such as property, plant and equipment, as well as investment securities. These investments are typically not part of your everyday operations of selling goods or services. Financing activities reports the issuance and repurchase of the company's own bonds and stock and the payment of dividends. What does a CFS look like? Here is a simplified sample showing the three different sections.
Cash flow statement, future value of annuity. The future value of an annuity formula is used to calculate what the value at a future date would be for a series of periodic payments. P is equal to periodic payments, R is equal to rate per period, N is equal to number of periods. The future value of an annuity formula assumes that the rate does not change. The first payment is one period away. The periodic payment does not change. Present value of single sum. The equation below calculates the current value of a single sum to be paid at a specific date in the future. This value is referred to as the present value PV of a single sum, where PV is equal to present value, FV is equal to future value, N is equal to number of compounding periods, I is equal to interest rate. Present value of an annuity. The formula below calculates the current value of a stream of equal payments made at irregular intervals over a specific period of time. This value is referred to as the present value PV of an annuity, where PV is equal to present value PMT, periodic payment amount, N is equal to number of compounding periods, I is equal to interest rate. Net present value. Net present value, NPV, is a formula used to determine the present value of an investment by the discounted sums of all cash flows received from the project. The formula for the discounted sum of all cash flows can be rewritten as minus CO is equal to initial investment, C is equal to cash flow, R is equal to discount rate, T is equal to time. Rate of return. The discount rate often used in capital budgeting that makes the net present value of all cash flows from a particular project equal to 0. A primary measure of investment worth is based on yield and known as the internal rate of return. The internal rate of return can be defined as the break-even interest rate, which equates the net present worth minus NPW minus net present value of a project cash flow in and out. The internal rate of return, or IRR, is the average annual return generated by an investment over a specific number of years from the time the investment is made. Net present value. Net present value, as part of which internal rate of return is expressed, is the value today of an investment's possible future returns in terms of its net inflow of cash when subtracted from the cost of the investment. Project selection and evaluation. Across all industry, there is one area of Six Sigma that can mean the difference between success and failure of deployment: project selection. Project selection typically starts with generating ideas. The biggest challenge is to select the ideas that have the highest chance of becoming beneficial projects. Methodology for idea filtration. Repeat, filtration. To increase the chances of success, all ideas generated for projects need to be evaluated on 4 parameters: linkage with organizational importance, feasibility of acquisition, organizational buy-in, organizational benefit. Capital rationing. Capital rationing has to do with the acquisition of new investment. Capital rationing is used as a means of putting a limit or cap on the portion of the existing budget that may be used in acquiring a new asset. Capital budgeting. Capital budgeting is fiscally responsible process that is designed to manage available resources to select the long-term projects that demonstrate the highest degree of potential to yield a high return on the investment of those resources. Capital budgeting requires understanding the balance between the amount of resources that will be expended, the rate of which those resources will be utilized, and how quickly the investment will begin to show a return, reach the break-even point, and eventually begin to show a profit. The preparation of a capital budget is a task that requires attention to detail, the ability to analyze and invest opportunity thoroughly, and an understanding of how to prepare projections that are based on solid facts. Projects of capital. Capital budgeting is a term used to describe the process of analyzing the projects for which finances in a company may have been earmarked with a view toward assessing the merits and demerits of applying the funds to such projects in both the long and short term. Capital budgeting is a term used to describe the process of analyzing the projects for which finances in a company may have been earmarked with a view toward assessing the merits and demerits of applying the funds to such projects in both the long and short term. Evaluation techniques for capital. The proper use of evaluation techniques and criteria should enable management to make a more effective decision which result in future success. The purpose of investment appraisal is to evaluate whether or not the current sacrifices is worthwhile. Capital investment decisions have certain characteristics. These characteristics are a significant outlay of cash, long-term involvement with greater risk and uncertainty because forecasts of the future are less reliable, irreversibility of some projects due to the specialized nature of a significant time lag between commitment of resources and the receipt of benefits. Management's ability is often stretched with some projects demanding an awareness of all relevant diverse factors. Limited resources require priorities on capital expenditure. Project completion time requires adequate continuous control information as costs can be exceeded by a significant amount. Factors to consider with capital projects. When considering any capital investment projects, there are 6 factors to be examined: the initial cost of the project, the phasing of the expenditure, the estimated life of the investment, the amount and timing of the resulting cash flow, the effect, if any, on the rest of the undertaking, the working capital required. Average rate of return. Average rate of return is a financial term that refers to the average amount of money earned or lost on an investment over time as compared to the amount actually invested. It is commonly also called return on investment (ROI) and is usually expressed as a percentage representing the total profit or loss relative to the initial capital. There are 2 basic ways of calculating an average rate of return. One which is limited to short-term estimates and one that is more suited for longer-term projections. Profitability Index. Profitability Index (PI), alternatively referred to as a profit investment ratio or a value investment ratio, is a method for discerning the relationship between the costs and benefits of investing in a possible project. It calculates the cost-benefit ratio of the present value (PV) of a project's future cash flow over the price of the project's initial investment. This formula is commonly written as PI equal to PV of future cash follows divided by initial investment. Terminal cash flow. Terminal cash flow is an accounting term used when analyzing capital budgets for a business or company. While cash flow describes the income and expenses of a business, terminal cash flow describes the income and expenses of a business at the end of or termination of a specific project or period of time. The term can also describe the value of a machine after it is scrapped or salvaged. After deducting any tax on net working value, the business is able to recover from the device during its ownership or possession. Summary. Let us now summarize what we have learned in this session. The time value of money impacts business finance, consumer finance, and government finance. The cash flow statement reports the cash generated and used during the time interval specified in its heading. The future value of an annuity formula is used to calculate what the value at a future date would be for a series of periodic payments. Net present value (NPV) is the formula used to determine the present value of an investment by the discounted sum of all cash flows received from the project. The discount rate often used in capital budgeting that makes the net present value of all cash flows from a particular project equal to 0.